Well, we have Disney, Uber, PayPal, Cloudflare. We have companies like Chipotle, MGM Resorts, and Pepsi reporting earnings this week. It's a very busy week. When I look at the actual schedule and I went over all these different companies, we can see the full list here. I went ahead and decided to circle and select the ones that I think are the most interesting. And so in red, we have the upcoming earnings of companies that I'm going to be going over in this video. I'll be giving you my full review of the companies, their fundamentals, what I think is already implied in the stock price, and so on and so forth. So we have a lot to go over in this video. It's going to be a very busy one. If you haven't already, make sure you subscribe to the channel and I'll do a follow-up on a lot of these different earnings. So after the results come out, I'll go over the fundamentals and see how things really went for the company. Now, before we even jump in, just a quick note, we're going to be using software called Qualtrim. This is something that I developed for my Patreon members. If you haven't tried out the Patreon, go ahead and try it out. It's risk-free. There's a free trial when you join. We have over 3,000 members. We've had like 300 members join in the past days. So we're getting to have a full house here. I think a lot of people are enjoying it. So if you haven't tried it out, give it a shot. There's a link in the pinned comment below. Now, before we jump into the individual earnings reports, just to set the stage here, I want to go over the type of atmosphere we're in right now. We're in an atmosphere where big tech just missed their earnings like crazy. Like if you haven't seen the last video, the previous one I did, Amazon, Google, and Apple all basically missed their earnings. It wasn't pretty across the board. I think that you can debate which ones are better than the other, but I think it's easily agreed upon that these companies are not crushing earnings right now. And that's been the story so far this earnings season. It hasn't really been incredible. So what investors are looking for are companies that can actually keep their earnings, not have it fall year over year. We have a lot of these big companies coming up, and in the Wall Street Journal, they highlight some interesting statistics here that I think set the stage. With about 50%, so half of the S&P 500 has already reported results thus far. Earnings are on track to see a 5.3% decline from a year ago period, according to FactSet. So earnings are down from 2021 to 2022 by 5.3% on average. That's why the market's gone down. Now the market went down a lot more, but earnings are down. Companies they're getting revised downwards and they're coming in below. They have additional information here saying fewer companies than usual are beating Wall Street's estimates this earnings season. So far, the S&P 500 companies that have reported their quarterly results, 70% had per share earnings above analysts' estimates. This percentage is below the 5-year average of 77%. So to summarize this, out of the companies that have reported so far, earnings are going down on average around 5.3%, so they're declining year over year. And then more companies are missing their earnings expectations. They're not beating the analysts' estimates. So basically, the S&P 500 in aggregate is going down. That's the stage. Earnings are down. If you can find companies that are just blowing away their earnings, beating earnings expectation, and giving strong guidance, those companies I think will be richly rewarded. Now, having said that, let's go ahead and start off this week on Tuesday with Chipotle, which is reporting their earnings Tuesday after market close. So tomorrow after market close. This is a company that I've had on my watch list. I've been interested in it. I've actually done quite a bit of work on this one, research on it, because I'm interested in the restaurant and quick service restaurant category. I own Starbucks and I own Texas Roadhouse. Those are both companies that I've made money on. So I like this category, but Chipotle's been one that I've avoided. Now, I will mention Chipotle is a large holding of Bill Ackman, who, say what you will about him, a lot of people don't like Bill Ackman, but I consider him a legitimate investor. He's beat the market for a long period of time. He has a concentrated portfolio that doesn't just mimic the S&P 500. So I consider him a value investor that's invested in a concentrated portfolio of cash flow companies, high cash flow companies. And Chipotle is a very large holding of his, making up around 21% of his portfolio. So he still holds this one, but it must be mentioned that he was buying in this one a long time ago. He's up significantly on it because he was buying it in 2015 and 2016. So he's up multiples on this company. Now, I've looked at Chipotle again a number of times, and I haven't had this one in the portfolio. I'll just be frank. Part of the reason that I haven't had this one in the portfolio is because I'm always looking for different risks for the companies that I'm investing in. And Chipotle has had quite the past with E. coli, which is basically if people working don't wash their hands, which is gross to begin with, but you get E. coli in fresh food and it poisons everybody that eats the food. And Chipotle has had an issue with that in the past because they're a burrito quick service restaurant, thousands and thousands of locations, and they serve burritos with fresh foods. None of it's really cooked except for the chicken. So if you get any bacteria in there, it just poisons everybody. The type of restaurants that I'm investing in are like Texas Roadhouse. Most of the Texas Roadhouse food is steak or fried foods or fries or anything like that, stuff that's cooked. You're a lot less likely to have issues of food poisoning with a place like McDonald's or Texas Roadhouse, where the majority of foods are cooked, than one where it's fresh. So I don't love the idea of owning a company where it's one E. coli outbreak away from the stock dropping 50%. So that has played a role in it. The other thing that plays a role in me not owning this company right now is simply the valuation. Let me blow this up for you. If we look at the PE ratio of the company, which I know is not the only consideration, but it is something I do look at, is the multiple of earnings it's trading at. There's just a lot baked into the price. A 35 forward PE ratio. So that's a lot. Then we have a free cash flow yield of 1.9%. So based on the cash flows, it looks better than based on the earnings. But regardless, it's a pretty pricey company. We look at the fundamentals of the company. I think they're extremely strong based off the numbers here. The cash flows are growing. They look terrific. Quarter by quarter, it's a free cash flow positive company. Stock-based comp has been declining since 2020. So the executives, managements, and the insiders of the company, they're actually taking less and less pay over time as the company's growing its free cash flow. I like that. I look at it on an annual basis, and we can get a little bit better of a picture here. The free cash flow per share exploded to the upside in 2021. And we'll see how this works in 2022. But again, I think this looks very strong. What I see here is a very strong free cash flow profile. And this is what Bill Ackman is looking at with this company. I know the reason that he's invested in Chipotle, despite the fact that it looks visibly expensive, is because he's considering that this company is going to have a ton of growth. I think he believes it's going to have a ton of free cash flow per share growth. So we look at this over the past year. Chipotle's free cash flow per share growth over the past 5 years, with this one spike in 2021, is a 57% compound annual growth rate. And it just doubled in a year. It actually almost tripled in a year. When a company can do that, it suddenly goes from looking expensive to looking pretty cheap. So if they can pull levers, if they can make their company more efficient, if they have more drive-throughs, less employees, more automation, better logistics, right? If they start doing all these things, if they have smaller locations that have less rent and less property taxes, they can really do things to boost this free cash flow per share. And then what this company's also doing, they're buying back their shares outstanding, removing the amount of shares outstanding, which also helps out. So they remove the shares outstanding year over year by 1.34%. So that's helping out a little bit. They're not diluting, but that's not the biggest factor. The story of Chipotle, and the biggest thing that's causing this company to do well, is increases in automation and efficiency in the company. For example, they're really pushing the Chipotle app. You have to buy the food in the app before you go through the drive-thru. So you buy the food and then you go through the drive-thru. It's already ordered and prepared, and you can just pick it up. So the drive-thrus are super quick. And then Chipotle also did something very sneaky. I thought this was pretty genius from this company. Some areas do not let you to have traditional drive-thrus with the big ordering billboard, with the big megaphone speakers. A city can decide with their rules that they do not want to have drive-thrus in those cities. Well, Chipotle got around this. They have a pickup lane. It's basically a drive-thru, but you basically just do the same thing with the app. So you don't have the big megaphone thing, you don't have the big screen, you just order through your app and then you go through a pickup lane. Not a drive-through, a pickup lane. So they sneakily got around all these locations that wouldn't allow them to have a drive-through. And that's, again, increasing the efficiency of this company compared to other ones. So I actually think there's a good thesis here currently with Chipotle. I think the company's probably good long-term. And I don't think people are dumb for investing in this company. I wouldn't go that far and say they're buying just this overpriced burrito chain. The more you research it, the more you realize there's a lot more that goes into the business. They're doing a lot of things that are very difficult to replicate. They have a lot of expansion possibilities. Having said that, another thing I'm concerned about with Chipotle is the price increases of their menu over the past 3 years. It's staggering. And normally I'd look at this as evidence of the company having pricing power, but you can only stretch that pricing power so much with food joints. They have really increased prices. If you look at their earnings reports, they go over their price increases, and they've been doing this quarter after quarter, trying to keep up with inflation, trying to keep up with employee costs. But now you go to a Chipotle, and for a burrito, it's like $9. It's an expensive burrito. And when you compare it to other places like McDonald's that just reported earnings last week and they had fantastic earnings, McDonald's has been much more disciplined, I think, in controlling their price increases and keeping their items very cheap. So that's a part of concern, is I think that Chipotle will have good earnings, this earnings report. So if I'm just looking at this upcoming Q4 earnings report, I think it's going to be solid. I think like McDonald's, they're going to probably beat their earnings or be somewhere really close to it. I don't think it's going to disappoint. But in terms of going forward, I am concerned about their ability to continue raising prices at the rate they have. I think they're going to have to slow down a lot. So in summary, Chipotle, I think, is going to have good earnings. I think it will do just fine this last quarter. But I think the stock is expensive. I think they flexed their pricing power already. It's not one that I'm looking at investing in currently. Uber reports earnings before market open on Wednesday. Now, Uber's a company that I've never owned before. I've never been that interested in it. This strikes me as the quintessential example of a company where the insiders love it. The people that got in, the venture capitalists that got in before it moved to the public equity markets, they love this company because it was a highly scalable company with a very unique business model. And it was just exciting, and it was something that the venture capitalists and the people that got in really early knew that they could sell this story to the public and make a fortune. They could make a fortune not by the economics of the business, not by Uber making money, but by selling the dream to the public. They could take the public's money and make a fortune. That's what I don't like about this company. I think it's one where the insiders got rich based off of the retail investors that they sold the company to. And the company itself has yet proven to make any money at all. Now, if we look at Uber, it is a $66 billion company. I mean, this thing has gone up past $100 billion in market cap, and it's never made any money, which is pretty astonishing. There's a lot implied by the price. We look at the actual performance of it all time, and this paints the picture here. Again, all time, since IPO, down 20%. The opportunity cost here was huge for investors. If they would have just put this money in SPY, they would have done really well. But this is always one that people talk about as potentially having a lot of potential down the road. So I don't like this type of investment. I think it's one of those self-serving type of companies. But in my opinion, and I said this before many times, I think it's much safer to wait until these companies actually show they're capable of making money. Then you can start to invest in it. And if it is such a great company, you won't have missed all the gains at that point. Now, having said that, the thesis right now for Uber, what they're trying to do and what the CEO has publicly said, is it's basically a race to profitability. They know the market has turned. They know investors want to see real cash flows. And so they're really trying to make the company cash flow positive. And I think that's going to be their goal for 2023, to make the company really cash flow positive over a full year basis. So we have the results for Q4 coming out. I'm expecting it to be cash flow positive. That's a good thing. They're moving in the right direction. I acknowledge that. So I think that if you're investing in Uber now, you're basically just betting that next year they're going to have a lot of free cash flow. It's not going to be negative. The big problem right now is they still have to pay those employees. They still have to hire employees. So even though they're printing positive free cash flow, we have stock-based comp that's still exceeding the employee payment. And then we can even see back in 2019, this huge spike in stock-based comp, $3.9 billion. So I haven't looked up who this went to, but some executive, some insider got their payday. And that's the problem I try to highlight with a lot of these companies. These Silicon Valley, really fancy companies that get sold to investors. A lot of them, they really reward the insider and they leave the investor, the retail investor, as the bag holder. So I don't love this investment. I wouldn't be buying this company right now. I realize it's exciting because it's ran up a lot over the past month. People are excited about these companies again. They want to have a repeat of 2020. So this is one that I think is very unpredictable. But if it beats on earnings, which I think there's a good chance of, I could see it flying after earnings based on the euphoria of the market right now. But in my case, I think it's dangerous, highly speculative. I would wait until this company actually generates real profits to make an investment. Now, moving on from that, we have the big one, which is Disney. Disney is reporting its earnings after market close on Wednesday. Now, before we jump into Disney, I have to give a big disclaimer here that I currently own Disney stock. I have it in my primary portfolio called my passive income portfolio. This is one where I invest in a lot of, I would say, high quality compounding companies. Now, Disney's a company that I've invested in since 2017, late 2017, and it's actually turned out to be my worst investment. When I initially invested in Disney, it was during a time period where I was a lot less sophisticated of an investor. I've learned a lot over the past 5 years. And my basic thesis for buying the company was the same that you could imagine any novice investor. Disney is a well-known company, has these magnificent parks and all this IP, right? They have all this different content that I think is difficult to replicate. So I basically bought into the company and I made a series of errors that cost me a lot of money on this stock. Error number one, I looked at their streaming growth as just an outright positive thing. I didn't factor in the declining cable business and the margins of that business. They have this high margin cable business just going down as they're gaining streaming subscribers. And overall, their companies made less money, not more money. So I didn't appropriately factor in the declining parts of their business. Error number two, I was undisciplined. When I was buying the stock went up to almost $200 per share at one point, and I was an owner of Disney at that time period. In fact, I was celebrating. I was spiking the football. Instead of minus 5,000, it said plus 8,000 at that time period. And I was taking a victory lap in a silly, undisciplined way. I wasn't paying attention to valuation. Instead, I was just looking at the bright future that Disney had. Then Netflix threw that curveball where they lost subscribers, and that caused Disney stock to crash. Now, I've decided to improve a lot of these things. I'm having a more disciplined approach. I'm paying attention to valuations. I'm doing a lot of things differently now, but that's been the story with Disney. So this one sits in the portfolio. I currently hold it. I have trimmed the position ever so slightly as this company has recovered over the past month. We can look at Disney over the past month and it's up 24%. That's a pretty good run. So the company is actually, it's had a little bit of a bounce, but it's still in the red over the past year by 22%. So let's go ahead and look at what my expectations are for this earnings report. The first thing that we have going on with Disney is they currently have an activist investor called Nelson Peltz trying to get a board seat, trying to impact the company. Now, I don't think that Nelson Peltz is some expert on media and entertainment. That's not really his business, but I still think he could do good just by being someone that's a critical voice on a board where I think the board of Disney is incredibly arrogant, right? So I think having someone there to just point the finger and say, hey, here's some of the mistakes you're making. Let's try to make corrections to this. Let's try to do better in the future. I think that's a good thing for Disney. So I support Nelson Peltz. I hope he makes progress. If anything, he's drawing attention to, I think, a lot of the problems Disney's facing, which I view as a positive. Outside of that, we have Disney's race to make money. The company's it's just losing money right now. So they're doing everything they can to start making money. We're seeing articles like this where they're changing their opinion. Disney could license content to rivals as part of Iger's new company direction. So they're licensing content to other people now. A couple years ago, Bob Iger said, we need to stop licensing content. We need to hog all of it to ourselves. Licensing your content, renting it out to other people is an effort to boost short-term profits. So now Disney's trying to boost the profits, trying to make the company look more attractive to investors, because again, the stock price has been crushed recently. We also have some, I think, just positive news for Disney. They've had a series of flops in the box office, but Avatar was not one of them. Now, James Cameron just amazes me because he comes out with these movies and they're always just massive hits. And I think, okay, he's going to run out of steam. This will be the first movie that doesn't reach billions of dollars. Nope, he does it again. Avatar was a massive hit. It's been in the theater for it seems like a year that it's been in the theater. And it finally got booted out of first place in the theater by M. Night Shyamalan's Cabin, the new movie that he came out with. Now, if we look at the current number that Avatar: The Way of the Water has done in the box office, it's incredible. Its global box office currently sits at $2.174 billion. Over $2 billion for one movie. So I think it's a good sign for Disney. They finally have like a massive success in the theater. It's getting people excited to go back to the theater in IMAX. And I think that's a good thing because Disney has their huge box office business. So if they can get that rolling again, they can start to get their metrics looking good again. Because again, they're fighting off this declining linear television business. The valuation has moved up a lot, so it's not as cheap as it used to be at a 17 or 18, but I'd say that the valuation of Disney, it's not that demanding of a valuation. I don't think there's too much euphoria priced in Disney right now. In fact, in my opinion, I think there's still a lot of gloomy sentiment priced in. Not as much as a month ago, but there's still gloomy sentiment priced in. The free cash flow yield, this is based off the trailing 12 months, which I think is not an accurate portrayal of Disney's free cash flow generation ability. They've proven time and time again they can generate free cash flows, and I think they'll be able to do that again. I think they'll be able to generate free cash flows. So I think that Disney is going through a tough transition, but this is a company that I've said for the past year I still think is undervalued. I don't think that there's a lot implied in the price. And I think there's been a lot of gloomy narrative, a lot of poor sentiment on Disney over the past year. And the story for this upcoming year, the story for Q4 of last year going forward, is that we have Bob Iger back now, and the streaming losses are going to be less and less and less every quarter. So on Disney's earnings reports, I'm pretty positive. I think it will be good, but I wouldn't bet on it. I still think it's a little bit risky. Now, let's go ahead and move on to Affirm. Affirm is reporting earnings after market close on Wednesday. Now, if you're not familiar with what Affirm actually is or what it does what America's favorite pastime is, which is to buy things that we don't have money for. It is a buy now, pay later company, where if you go and you want to buy something and it's a little bit more than what you want to spend right now, you can break up the payments into like 4 payments over a 6-month period or something like that. Now, if I have to make a prediction on this company's Q4 results, I think they're going to be good. I think it's going to beat expectations. That would be my guess. And I say that because of the data we have from the big credit card companies, MasterCard and Visa. Both of them reported earnings and they were both great. People are spending money again. They're spending money on cards and they're borrowing money. So I look at this company, and even though I think they'll beat earnings, I still think it's highly risky. Look at what this stock has done over the past month. Just a month, and it's gone up 99%. It's doubled in stock price. These are the type of companies that I think are incredibly risky. They're speculative. They don't make any money, and they're seeing a little bit of a resurgence. So we have a lot of euphoria in the market right now. A lot of people diving in. I think there's a lot of short sellers getting short squeezed right now. I think there's a lot of that type of stuff going on. In my opinion, I would not jump into a company like that. It's not my investing style. I've sworn off any type of speculation into any of these type of companies. I just think that it's basically gambling. And if you are investing in a company like Affirm, just be aware this is the type of company that could drop 20 or 30% in a single day if it doesn't meet its earnings. So it's highly speculative, highly risky. Just keep that in mind if you're speculating on that type of company. Now, the next one that I think is very interesting, and I'm interested in this earnings report, is MGM Resorts. Why am I interested in this one, even though I'm not invested in the company? Because I own another company called Vici, and MGM Resorts is one of their largest tenants that pays them rent. So I own the landlord of MGM, and MGM makes up around 40% of their total rent. So the health of the tenant is important to the health of the landlord. If MGM can't pay rent, then Vici, my real estate company, is in trouble because it can't collect rent. So I pay attention to these companies' earnings reports. So let's go ahead and take a look at how MGM Resorts is doing and how this company is currently valued. If I look at the valuation, the first thing I notice is the very high forward PE ratio, 51. I don't believe that. I'd have to do research and see what's throwing off that forward PE. I'm more inclined to believe the trailing PE of 13.7. And then if we look at the free cash flow yield, this looks more normal right here. A 7% free cash flow yield. So the company's trading at a very high free cash flow yield, which means it's at a very low valuation. Why do companies like MGM, casinos, trade at lower valuations? Because they're cyclical. Now, if you don't know what the term cyclical means in terms of investing, it means occurring in cycles. And when people talk about cyclical companies in investments, they're talking about the cash flows of the company occurring in cycles. And that's typically an unattractive trait in a company. Let me illustrate what this looks like with the chart here. This shows a highly cyclical company. We have time periods where the cash flows are negative, where the company's not earning money, then time periods where it earns money, losing money, making money, making money, losing money, so on and so forth. It goes through cycles, making the company cyclical. And this is likely how this industry is going to be in the future. It's just the way things work. Some industries are like this, some are not. I prefer companies typically that are less cyclical than ones that are highly cyclical. Now, right now, the company's making a lot of money, so they should be using this wisely to pay off debt, to bolster their balance sheet, so that when they go into the other part of the cycle, they can continue to pay their rents and they can be liquid. So we look at the company's balance sheet here, and this is always the concerning part of casinos in Vegas. We know that they've ran into trouble in the past. If I look at this on a quarterly basis, we can see that they've been running around $14 billion of long-term debt, and they're actually starting to lower this, which I love to see. The company went down to $12 billion in debt, and then the latest numbers, where they're at right now, the latest amount of debt is $7.21 billion, and they have currently $5.3 billion in cash. So over time, their long-term debt has gone down dramatically. It's been cut in half, and their cash balance has gone up dramatically. It's tripled, meaning that they basically have $500 million of net long-term debt. That's great. That means this company actually has a strong balance sheet. I think they're actually in very good shape. They have obligations with their capital leases. This is Vici. So these capital leases, this obligation they have is literally to pay rent to my holding, which is Vici. So that's an obligation they have, but they should be fine with the situation the company's currently in because they brought down the debt and they've increased the amount of cash. And they are generating a lot of cash over the past 6 quarters. And hopefully they don't go through a terrible cycle like they did in 2020. We want to avoid that in the future. So I think that MGM is actually in good shape right now. As far as I can tell, the company's making a lot of money. The most recent earnings reports before this one were that these companies, the casino companies, Caesars and MGM, are having their best years ever, their best quarters ever. Caesars said in their last earnings report that they made more operating cash flow than they ever have in the history of Vegas, the entire history of their operations. So they need to be taking advantage of this, paying down debt, getting their companies in stronger positions. I think based off of its historical valuation, the MGM is still probably undervalued right now. I think that there's probably more upside than downside in the stock. So overall, I'm bullish on MGM. I think that MGM is going to do great. I think Vegas in general is just, it's one of the most exciting places on earth right now. People love traveling there. They have so many things going on. The Formula One and everything going on there this year, I think is going to be incredible. So I'm very bullish on MGM as well as Caesars. Caesars has a much worse balance sheet. They're in a more difficult situation, but I think that they're making a lot of progress. They're moving in the right direction. Now, moving on. We have the consumer company, the consumer defensive consumer staple behemoth, which is Pepsi, reporting earnings before market open on Thursday. Now, again, we're looking at the passive income portfolio here. This is my primary one where I bought into Pepsi as a smaller holding and I actually made a little bit of money. So I was up $500 on the company. And this was basically a play that I was excited that I didn't lose money. 2022 was a tough year for investing. Pepsi just strolled right through it. And that's what this type of company is for. It's extremely defensive. It's difficult to lose a lot of money with Pepsi. My overall thoughts on Pepsi is that I think that these type of companies, the very defensive ones, they've been so good over the past year that I think they got bid up a little too much. I think investors sought them out as a place to seek shelter. And as soon as the market started going back in bullish mode, these type of companies, I think, have a period of cooling off. Because again, the valuation ran up a lot. You're paying a 25 forward PE for a company like Pepsi that has very slow earnings growth. So this year, while the rest of the market has gone up, Pepsi has retraced a little bit. It's actually given back some of the gains. So I'm not super enthused about this company in 2023. I think as interest rates come down, if the market recovers, I think Pepsi is going to be one of the companies that probably underperforms. That would be my prediction. Now, after Pepsi, we have the giant payment processor, PayPal, reporting earnings after market close on Thursday. PayPal is an interesting one. It has a lot of different opinions on this one. We have Terry Smith, who just recently bashed PayPal in his investor letter, said that he didn't like his communications with the management. He didn't like how they took the app and they didn't really do anything with the customers that they gained during COVID. all that type of stuff. He really doesn't like the company, and he sold out of his position. Now, looking at the numbers here, I actually think PayPal looks somewhat attractive right now. The company's forward PE ratio is at a 15. It's not a lot implied in this price. There's a lot of negative sentiment in it. The free cash flow yield's at a 5.73%. Again, this doesn't imply a lot. There's not a big hurdle that this company needs to overcome to justify its current valuation. So already I like the setup here. And another thing we can look at here is the sentiment change on this stock. 2 years ago, PayPal was one of these special companies where there wasn't any price too high to pay. It was trading at a 40 or 54 PE ratio at a price at $300 per share. Then it traded down 70%. So it's dropped 70% in value, currently trading at $85 per share. Now nobody wants to touch it. Most of the time when I see this happen, when I see everybody finally decide that a company's dead, in most cases, that's usually the time to buy the company. After it's dropped 70% in price, after nobody wants to touch the company, that's usually a sign that it's really hit rock bottom valuation. And again, these valuation metrics here, they don't leave a lot implied in the price. So you don't have to have a huge hurdle here. When I look at the revenue, it's growing 10% per year. I like to see that. The EBITDA, generally speaking, is going up over time. I like to see that. The free cash flow looks like it's pretty consistent. There hasn't been any big free cash flow changes. So maybe it's not growing as fast as people would like, but it's a free cash flow positive company. And the stock-based comp is actually declining over the past 3 quarters. Another thing I'd like to see is that they're growing their free cash flows, or at least maintaining them, with their expenses under control. So the story on paper of PayPal actually looks pretty decent. The valuation doesn't have a lot implied, and sentiment, I think, is at a very low point. In my opinion, if I had to take a guess here of how PayPal's earnings will go, I think there's more room for upside than downside. Now, I'm not buying the stock, so I wouldn't bet on this, but just looking at the numbers, what's implied, and the sentiment of the company, I think they have more room to surprise to the upside. Now, after PayPal, we have a smaller company called Cloudflare reporting earnings Thursday after market close. Cloudflare is a great company. I think they have great products. They're a highly innovative, disruptive tech company. Their main product, what put them on the board, what made Cloudflare the company they are today, is their DDoS solution. DDoS attacks are when someone uses a series of bots to request a website millions of times. So they basically do so many requests to a website that it overcomes a server and it causes the server to crash. So if somebody wants to take down your website, they can do a DDoS attack. Now, of course, that's illegal, but it's something that a lot of people do on the internet. This company came out with a solution where it basically protects a website from that ever happening. So the website remains up. And with that product, they were able to roll that into a other series of products that they've came out with web security, with web hosting, with all sorts of different things. So they're highly innovative. They're always building new things, inventing new things. Having said that, I think the company is just straight up overvalued. I think it leaves too much implied in the price. And I know this is a great company, but I just look at some of these metrics here. Now, they're not making money currently, but they probably will be this year in 2023. But I just look at some basics here. This is a $20 billion market cap company that currently doesn't make anything, that has currently no real positive free cash flows, and they're trading at a price to sales of 18. So consider that, a price to sales of 18. That means that you're paying 18 times their trailing revenue. 18 times their trailing 12 months of revenue. So if you're investing in this company, you just have extremely high expectations already priced into the stock. And I think that leaves limited upside and a lot of downside if things don't go well. Now, the company, like a lot of these companies, have run up a lot this year. There's been short squeezing or investor enthusiasm, whatever you want to call it. Either way, a lot of these companies that I consider a little bit lower quality with their fundamentals have had a really good run. It's up 40% year to date so far. We look at the revenue growth, that's growing over time, but we have that pesky free cash flow, and the company, like a lot of these, hasn't made money and it's not making money right now. The expectation is that it will start to turn free cash flow positive this year, so in 2023. But I think even if it does, it's going to be tough for it to get to a point where it's so free cash flow positive, it actually makes up for all the dilution it's doing. So it even has that additional hurdle. It's not enough just to make money. The money made has to surpass what you pay your employees. But again, when I look overall on Cloudflare, I realize it's a great company. I think that they're going to be doing a lot of great things, but I don't like how much is already baked into the price. A $20 billion market cap, an 18 price to sales, just barely turning the corner of free cash flow positive. I think it has very, very high expectations. So that one's one that I'm not going to be investing in as of right now. So that's it. That's this week. I hope that you got something from this video. If you did, leave me a thumbs up, as well as subscribe to the channel, because I'm going to be having follow-up on a lot of these companies. So if you're interested in seeing my follow-up analysis on when they actually report their earnings, make sure you're subscribed and I'll have more videos out this week. That's all for now. I'll see you in the next one.